to this open meeting of the Federal Reserve Board. Thank you in advance to the staff for your presentations today, and thank you to everyone who worked to bring these proposals together. Our financial system remains sound and resilient. Stress testing helps us understand how to maintain that strength by making sure that large supervised institutions have sufficient capital to absorb losses and continue lending to households and businesses, even during a recession. Born out of reforms following the global financial crisis, stress testing has been an important element of the board's regulatory framework and supervisory program since 2009. Last December, we committed to improving the transparency of the stress tests and reducing the volatility of resulting capital buffer requirements. Today's meeting is a step in following through on that commitment. The proposals would have us seek comment on the stress test models, on change to the framework that governs the design of the hypothetical scenarios, and on the scenario for next year's stress test. I look forward to the presentations, and I will now turn things over to Vice Chair for Supervision, Bowman.
Thank you, Chair Powell. I'd also like to begin by thanking our staff for their work on the stress testing proposals that we are considering today. These proposals fulfill the board's public commitment to seek comment on comprehensive changes to the supervisory stress test. Last December, the board committed to the basic contours of these changes, including to disclose and seek public comment on all of the models that determine the hypothetical losses and revenues of the subject banks under stress, public comment on changes to the framework that guides the design of the hypothetical scenarios, and finally, to ensure that public comment will be solicited on the hypothetical scenarios for the upcoming 2026 stress test. The staff have done excellent work to develop proposals that fulfill this public commitment, and they have gone to extraordinary lengths to inform our board members about the content of today's proposals. With that said, however, I am disappointed that the board's actions to address longstanding issues with the stress testing framework were not addressed proactively, but instead only after a lawsuit became inevitable. The board's 2024 public commitment to make these changes was done in the interest of avoiding litigation, challenging the legality of the stress testing framework. Since its inception, the board's stress test program has operated with limited transparency, unreasonable year-over-year volatility, and the absence of a meaningful appeals process. These issues come as no surprise. We've been aware of these concerns for several years. Many of these issues and the growing threat of litigation over the past few years, and the board did not take meaningful remedial action before I became the Vice Chair for Supervision. In my view, going forward, the board should not wait for the threat of litigation to become reality before addressing known problems with any of our regulations. With this background and procedural history, I would now like to briefly discuss the substance of the proposals before us. Today's proposals are designed to address the lack of transparency and public accountability in the Federal Reserve supervisory stress test process for large banks. This is a necessary improvement to promote due process and transparency. Currently, the stress test models, scenario design framework, and specific scenarios are not fully disclosed or open to public comment. This lack of transparency can lead to uncertainty for banks in capital planning, potential misalignment of capital requirements with actual risks, and limited public understanding of and scrutiny of the stress testing process. The proposals we're considering today seek to resolve these issues by publishing detailed information about the stress test models, the scenario design process, and future scenarios for public comment. This would enhance banks' understanding of their capital requirements, improve the reliability of the supervisory models through public feedback, strengthen market discipline, and increase overall confidence in the fairness and effectiveness of the supervisory stress tests. As Vice Chair for Supervision, my responsibility is to advance this important package of stress test reforms, reinforcing the board's commitment to enhancing transparency and public accountability in the regulatory process. Given the comprehensive nature and complexity of these changes, it was essential to give all of our board members sufficient time to carefully review and fully understand each component of the proposed reforms, which we have done. This approach supports a robust and well-informed decision-making process. So in closing, while there may have been opportunities to address certain issues sooner and thereby potentially avoiding litigation, I would like to again recognize the dedication and professionalism of the board and the Reserve Bank staff in preparing the proposals we're considering today. You have done excellent work, and I look forward to receiving feedback from the public as we move forward with these proposals. So I'll now turn to our staff to provide details and to answer questions from board members.
Thank you, Vice Chair Bowman. In December 2024, the board announced that it would seek public comment on significant changes to improve the transparency of the supervisory stress test. The package before the board today would achieve this objective by seeking public comment on the stress test models, the framework that guides how stress test scenarios are designed, and the scenarios for the 2026 stress test. The package would also propose to codify a process to publish for public comment scenarios and material changes to the models in the future. Stress testing is a core element of the board's regulatory framework and supervisory program for large banks. The stress test enables the board to assess whether these banks have sufficient capital to absorb potential losses and continue lending under a set of hypothetical severely adverse conditions. Since 2009, the large banks in the stress test have more than doubled their capital levels. To conduct the stress test, the board develops a severely adverse economic scenario consistent with a hypothetical deep recession. After selecting the stress test scenarios, the board uses the models that it has developed, along with financial data submitted by banks, to project how banks are likely to perform under the hypothetical severely adverse scenario. The results of the supervisory stress test are then used to inform each firm's stress capital buffer, a key component of its overall capital requirement. By linking the buffer to the stress test results, this approach increases the risk sensitivity of regulatory capital standards, more closely aligning them with the specific risks each institution faces. As a result, a bank's capital needs are better matched to its exposures as long as stress test results remain reasonably stable from year to year. The proposals within the package would increase the transparency and public accountability of the stress test by publishing for public comment detailed descriptions of 1. The board stress test models, 2. The stress test scenario design process, and 3. The scenario for the 2026 stress test. First, the detailed model descriptions would include the equations, variables, and coefficients used in each model, assumptions and limitations of each model, rationale for modeling decisions, and discussions of alternative models. The proposal would also invite public comment on specific model changes that the board plans to implement in the 2026 stress test, including changes intended to address the sensitivity of pre-provision net revenue projections to recent bank performance, as well as to improve the design and related assumptions for the operational risk and securities models. Publishing detailed descriptions of the stress test models for public comment has benefits. The greater transparency would enhance public accountability and promote confidence in the fairness of the supervisory stress tests. The disclosure process would also create a new mechanism for obtaining feedback from the public, including academics, financial analysts, and banks, on the design and specifications of the models, which should lead to model improvements. Additionally, as mentioned, banks would gain a clear understanding of how their risk profiles affect their stress capital buffer requirements, reducing the likelihood of unanticipated stress test outcomes and allowing for better capital and business planning. This, in turn, could enhance firms' ability to supply credit to households and businesses, ultimately supporting economic growth and financial stability. The second aspect of the proposals seek public comment on how stress test scenarios are designed in order to increase the predictability and transparency of the supervisory stress test. The scenario design policy statement which sets out the board's expectations for the design of the stress test, currently contains guides for two variables, unemployment rate and housing prices. These guides provide that these variables change by specified amounts and/or reach specified levels over the projection horizon of the stress test. This aspect of the proposal would enhance the existing guides for the unemployment rate and housing prices, as well as introduce detailed guides for several additional variables related to the US and international economies. The proposal would also include details on the macroeconomic model used to formulate the paths of the variables that are not determined by a guide for a given annual scenario. The proposal would also contain additional information about the framework and model components used to create the global market shock, including a description of the logic underlying the severity of the shock, as well as a description of the models and processes used to generate the shock. The proposal would seek feedback on the board's intention to simplify the global market shock by reducing the number of model risk factors and to increase the coherence of the global market shock by reducing the liquidity horizons used to calibrate the risk factors. Neither the annual scenarios nor the output of the macroeconomic and global market shock models represent forecasts of the Federal Reserve. As a result of these proposed revisions, the severely adverse scenario would be more transparent and predictable across supervisory stress tests. Staff estimate that in aggregate, the proposed stress test model and scenario changes would not materially change capital requirements for firms subject to the supervisory stress test across various stress test scenarios and jump-off conditions at the start of the test. This proposal would also propose to codify an enhanced disclosure process for the future, under which the board would annually publish comprehensive documentation on the stress test models, invite public comment on any material changes that the board seeks to make to those models, and annually publish the stress test scenarios for public comment. This process would underscore the board's continued commitment to the transparency and public accountability of the stress test. The proposal would also contain certain revisions to better facilitate the transparency and public accountability changes in the proposal. For example, to help ensure that economic data and firms' balance sheets would be set prior to the release of the proposed scenarios, the proposal would change the jump-off date of the stress test from December 31st to September 30th. The third aspect of this proposal would solicit public comment on the severely adverse scenario that the board intends to use for the 2026 stress test. As proposed, this scenario would be characterized by a hypothetical global recession triggered by an abrupt decline in risk appetite that causes substantial declines in the prices of risky assets, declines in the risk-free interest rates, and high levels of volatility. The global market shock component of this scenario would be characterized by heightened market expectations of persistently high inflation and high commodity prices, which could lead to a global recession. Finally, the proposal would also make several revisions to reporting forms to remove items no longer needed to conduct a stress test and to collect additional data that would improve risk capture. For example, the proposal would remove supporting documentation requirements, which should reduce burden by over 10,000 pages on average for each bank subject to the requirements. Thank you for the opportunity to present this proposal to you today. We would be happy to answer any questions that you may have.
Thank you, Doriana. So now we have an opportunity to ask questions, beginning with Vice Chair Jefferson, please.
Thank you very much. And I want to thank the staff also for all of the materials that you presented to us in anticipation of this meeting and for the presentation. I have a series of questions that I would like to ask, and so let me start. First, as was mentioned in the presentation, this proposal would move the jump-off date of the stress test from December 31st to September 30th. That is the balance sheet that would feed into that, okay? Now, also mentioned in the proposal was an additional provision that we have out with regards to averaging that was thought to, if it were finalized, would also have the effect of smoothing out the test results. Now, I am considering how these two proposals might interact, okay, in the sense that it could be the case, if both were finalized, that the balance sheet data that would go into the test could be a couple of years old at least. So if you imagine both rules were finalized, then the inputs to the process would be the balance sheets as of September 30th for last year and what we call in the academic world the prior year, that is the year before. And so to start, I'd like to know what your thinking is about the freshness or staleness of data. That is, we would be basing the stress capital buffer on data that was a year or more old.
Thank you, Vice Chair Jefferson. I'll let my colleague take this question.
Yeah, thank you. It is true that under this proposal, as Doriana mentioned, we would be moving the as-of date back by 1 quarter. But we think that is an important part of this proposal because it would ensure that the proposed scenarios that we put out are public after the firms finalize their balance sheets. So this would allow or ensure that firms are limited in their incentives to kind of shift their balance sheets in reaction to our proposed scenario. This would also align with our current process whereby we put out the scenarios only after the firms have finalized their balance sheets. As you note, there is another proposal out about averaging, and I think it's important for, we're considering the comments on that, and we'll think about that proposal. But today, we want to talk about this proposal, and this proposal, that's the reason why we're proposing to move the as-of date.
I understand that, but my question is, how are you all thinking about the fact that the data that would go in to the actual test would be somewhat dated or could be somewhat dated? Is that something that we should be concerned about or has any implications or not?
I think so. In this proposal, we're trying to balance that kind of the aspect that I spoke about not ensuring that the firms are kind of unable to shift their balance sheets in reaction to the scenario that we put out. In terms of the volatility proposal that we proposed earlier this year, I think there we're kind of trying to balance the predictability and reducing the volatility of the stress test with the staleness concerns. So those are kind of the trade-offs that we would need to consider.
In the presentation just now, since you talked about predictability, I think the phrase was used, if we were to do this, it would be more transparent and more predictable. So that led me to be thinking about what is the relationship between transparency and average with regards to predictability. Is it the staff's view that they are complements? Are they substitutes for one another? Because if this proposal is finalized, then it seems to me the testing regime is going to be much more transparent. And if it's much more transparent, then I could imagine that it would be more predictable. In fact, I think I'm quoting here that it would be more predictable. So is that increased transparency, in fact, a substitute for averaging in terms of mitigating the volatility that has been a concern of some people?
I think that's a good question. There are other aspects, or just to start out by your original point, I think that is absolutely correct. This proposal is meant to increase the transparency and the predictability of our stress testing regime. And we, as Doriana had mentioned, have a lot of reasons why we think that increased predictability is really good and is helpful to the firms to help them sort of plan their capital and be able to plan their business activities. I think that you raise an interesting point about whether increased transparency is a substitute for reducing volatility. I think in our view, it would be good to have both proposals considered by the board. And that's why we've brought this one as well as the volatility one forward.
Right. Okay, so I think that's going to be something important to consider because I can imagine we want the data to be as fresh as possible. We want transparency. We want reduced volatility. And so I think we could be considering what trade-offs or substitutability there is between complementary or substitutability between these two proposals. The proposal mentions the interaction between the two proposals. And so this is another aspect. And I know we all want to be thinking comprehensively about all of the regulatory proposals, and this is one aspect of it that came to my mind. I have another, if you will, question, Chair, if you allow me. Sure. It has to do with the potential for balance sheet optimization based on the stress test. Can you just say a little bit more about how this proposal would limit the bank's reaction in terms of trying to optimize their balance sheets?
Yes, I'm happy to take that question. So that's something we thought about very, very carefully. I would say that, staff is very dedicated to conducting internal analysis and ongoing model monitoring precisely to identify instances where risks might be building up on banks' balance sheet for a variety of reasons, including adjustment to balance sheets in an opportunistic way. Going forward, our own internal analysis, leveraging supervisory analysis, which we do all the time, would help us determine whether the models are still performing as intended, and it would allow the board to propose model changes to address those considerations. I would also say that this is not just forward-looking in the proposals that's before the board today. There are already a number of proposed changes that were proposed with those considerations in mind. And to give you an example for that, I would say that one of the important proposals is a change to the as-of date for the global market shock, which would no longer be limited to a short window of time, but we would be able to select the date year-round.
Thank you, Chair.
Thank you. Vice Chair for Supervision Bowman, please.
Thank you, Chair. So Doriana and Hillel and Patrick, subjecting the models and scenarios to public comment is a critical step to increase the transparency and public accountability that I talked about earlier for our stress test. In all of our capital rules, we disclose the formulas, including how we risk weight different assets in those rules. This is valuable in that it lets the public know how regulators assess the risks of different activities and business lines. And it allows us to get the views of the public on the assessment of those risks. And yet we've long been reluctant to show our work. And there have been credible claims made that some of the elements in our prior approach to the stress tests have been unrealistic and significantly miscalibrated. So help us understand what the benefits of this level of transparency and public accountability are as we're considering in the proposals before us today.
Yes, I'm happy to take that question. So first of all, the first thing I would say is that this package of proposals today goes to fulfill this commitment that the board made to continue to enhance the transparency of the stress testing framework and reduce the volatility of capital requirements in order to increase the resilience of the stress testing framework. The proposals have a lot of benefits. The first one is it would increase the credibility of the stress test because it would add confidence to the fairness of the stress test. The public would be able to better understand the stress test results each year. They would be able to better connect the risks underlying the results for each of the firms covered by the stress test. It would also help the banks themselves to better understand their own results. It would support better business planning. It would support better long-term capital planning. in our review of the academic literature, that in turn would lead to increased credit supply to households and businesses. But I would say, last but not least, arguably one of the most important benefits is really this new mechanism to collect feedback from the public, from the broader public, on the set of supervisory stress testing model and scenarios, which we really do believe will, over time, lead to more robust and more stable models.
Great. Thank you very much. I look forward to the feedback on the proposals. Thank you, Chair.
Thank you. Governor Waller, please.
No questions.
Okay. Governor Cook, please.
I have a series of questions too, if you'll indulge me. And I'd also like to thank the staff for their extensive work on this proposal. Full disclosure of the stress test models and scenarios could enable a bank to optimize its stress test results by adjusting its balance sheet to concentrate on exposure where the stress test models may underprice risks, which could result in lower capital requirements without a material reduction in the riskiness of the bank. Over time, this behavior could lead to concentration across the system in assets that receive comparatively lighter treatment, which could create financial stability risks. How does the proposal address these concerns? What tools does the board have for monitoring these risks?
Thank you, Governor Cook. So I'm going to return on one of the earlier points to say that we are very focused on opportunities to keep our model framework dynamic, resilient, and risk-sensitive as it is today. That includes extensive analysis to make sure that if risks are building up on banks' balance sheet, including for the reasons that you just cited, in the cases where the stress test is or may be perceived to be more benign, or may be perceived to be treating more benignly certain asset classes or certain portfolios, in those instances, we would be able to recommend to the board to propose changes to the models to address exactly those concerns. And additionally, public input, this additional channel through which the public would be able to also monitor the models and also help us identify and address those risks as they're building up, will be incredibly helpful to make sure that we address them in a timely fashion.
For the past few years, the board has conducted exploratory analysis that is distinct from the supervisory stress test linked to stress capital buffers. This exploratory analysis and tests explored additional hypothetical risks to the broader banking system, but they did not affect capital requirements. Would this proposal inhibit the board's ability to continue to conduct similar exploratory analysis?
Thank you. I'll let my colleague take this question.
Thanks. Thank you, Governor Cook. The proposals that are would not affect the board's ability to conduct other analysis to inform supervision or risk to financial stability.
The proposal would implement guides for additional scenario variables. These guides would be more of a binding constraint on the paths of scenario variables than it is today, which would make the scenarios more predictable and less dynamic. How should the board think about using more predictable scenarios in the stress test?
Thank you, Governor Cook. I think the scenario, macro scenarios, are calibrated against severe post-war U.S. recessions, and generally the Great Recession in particular, the 2007 to 2009 experience. So those scenarios feature they share a lot of common features. They are large credit-driven contractions and are generally the most stressful kind of scenario that banks face. I think you should think about this as this is the scenario that is most impactful for the broad banking system as a whole. And they share many features, many commonalities, across time. And the guides that we're proposing contain within them ranges that permit some amount of variation in response to current economic kind of macro financial conditions.
Just one final question. The proposal would reduce the regulatory reporting burden. Would we lose anything significant needed to conduct the stress test or effectively supervise banks?
None of the items that we're proposing to remove from the regulatory reports would impact the board's ability to conduct the stress test or effectively supervise banks. The proposal would add some select items to increase risk capture in the supervisory stress test, including information about hedges and loss sharing agreements. But overall, we would not expect it to impact our ability to run the stress test.
Thank you.
Great. Thank you. Governor Barr, please.
Thank you. Let me add my thanks to the staff for the enormous amount of work that went into this proposal. I had a chance to obviously talk extensively with all of you about it, and I really appreciate the interactions we've had as we worked through the issues to make sure I understood them. I might just focus a handful of questions on changes to the risk models themselves that are included in the proposal. It's my understanding that changes to the credit risk and operational risk and market risk models themselves would make the stress test somewhat more optimistic than in the past by about 100 basis points or 115 billion in capital. So I wanted to focus on a handful of those changes and get your assessment of them. So, for example, there's a change to the way that the probability of default is estimated in the corporate loan model that my understanding is would make it less conservative. So I'm wondering if you could just walk me through that.
Yes, I can take that question. So first, I would start by saying that our analysis using the 2024 stress test and the 2025 stress test shows that over time, the combined impact of our proposed changes should not materially affect capital requirements. It is indeed the case that the proposed changes for operational risk, credit risk, and market risk would lower the severity of the stress test, but they're largely offset by proposed changes to pre-provision net revenue and the securities model, so that on net, the impact would be about muted. So that particular change to the probability of default of corporate loans is one that we've been working on for a while. It would in fact decrease corporate losses for, I think, a very sound reason, which is that the model that we had previously was based on an estimation sample that was relatively short. It was 2006 to 2014. Now, the proposed model change is a better model relative to the one we had before because it uses the fact that we have much more granular information that we have accumulated since then. Banks' activities have evolved dramatically since the period of time in the global financial crisis, so it's using a broader estimation sample. And that's really the driver behind that. One of the reasons why the estimated losses would come down with the model change is that it is a model that's sensitive to the macroeconomic scenario, as it does make sense and it should. The previous specification had several macroeconomic drivers, some of which were not always statistically significant depending on the samples that we were using. But under the current specification, it is the BBB spread that's the most useful driver, and that's what the specification for the model is now.
Thanks, Doriana. Let me ask you about a couple others. So there's changes to the assumptions about loss given default in the market risk model, and there are changes in the assumption on draw rates for lines of credit in the market risk model. And you just say whether that is more conservative or less conservative than the current approach?
So those two proposed changes, those apply to the fair value option models. Is that right? Just making sure I'm hearing the questions correctly. So those changes are less conservative than the current assumptions in the models. This is another instance where we have been able to utilize more bank data, and that bank data has illustrated to us that the assumptions that we had before were unduly conservative, and so we have revised them appropriately. So yes, that's correct.
And then last question on the model changes, there's also a shortening of the liquidity horizons in the global market shocks. I wonder if you could explain whether that is less conservative or more conservative than we're currently using.
So that's a really interesting question. So the liquidity horizons, maybe just for context, simply put, they're the estimated times that it would take a bank to either exit a position or properly hedge a position under stress without materially affecting asset prices. The proposal here today is to shorten those horizons, which currently extend up to a year for liquid and illiquid assets, to be all within 1 quarter. We're proposing the change because the global market shock losses currently are assumed to be realized within 1 quarter, the first quarter of the projection horizon, and that change helps with that coherence argument. Once we reduce the window for the liquidity horizons, losses are generally coming down, but it avoids outlier outcomes in both directions, because when it comes to trading, there's multi-directional risks. So we're eliminating outlier results both when it comes to losses and when it comes to gains.
So that's super helpful. Andreas, I have a question for you. Could you describe for the board what happened to Fannie Mae and Freddie Mac's stress testing system before the financial crisis?
You mean the stress tests that were used by the regulator?
Mm-hmm.
Yeah. So my recollection is that the risk-based capital regime that existed for Fannie and Freddie was based on a stress test where the scenario was specified by law, in the early 1990s, and the models, were developed by the regulator, OFAO.
And how did they perform?
I mean, you mean through the Great Recession? So I think it's important to remember that the scenario that was specified, in the early 90s and was set in law was actually quite mild compared to the actual events that actually transpired. I'm sort of going on memory, but as I recall, the house price path was not particularly severe, relative to the actual, enormous declines that occurred between 2007 and 2010. So the short answer to the question is they did not do very well, but in some sense, that was for a multitude of reasons.
Got a question or maybe two for you.
Okay.
In your judgment, is this proposal legally required?
Governor Barr, as you know, we're in active litigation regarding the stress test. But I will say we do, as Doriana mentioned, do recommend taking the steps in the proposals to increase the transparency and public accountability of the proposal.
So which is it?
We do recommend that we take this step.
Great. Thank you very much.
Thank you. Coming in remotely, Governor Myron, if you have any questions, let us know.
Sure. Thank you. Just one brief question. So some observers have in the past criticized the global market shock as complex, unrealistic, inconsistent with the hypothetical macroeconomic scenario, and designed to reach overly costly outcomes. The proposed 2026 scenario seems to check at least some of these boxes. How does the proposal seek to address these concerns, and what feedback are the staff hoping to obtain through the comment process on these topics?
Thank you, Governor Myron. I'll be happy to take that question. So there are two proposed changes to the global market shock. We've briefly touched on one, which is the liquidity horizons. The other proposed change is a dramatic simplification of the framework, where we would be reducing the number of published shocks for the global market shock from currently about 20,000 down to 2,300. Now, this is without any loss of severity, and we would be publishing fewer shocks, but we're also publishing full documentation on how those are mapped with the other shocks to the other asset classes. Now, I would say that in totality, these two changes go a long way to address the criticism that you mentioned. They will help the public better understand the logic behind the severity of the global market shock. They will help the public understand the processes that we use to generate those values, how we specify them. In addition to that, because the global market shock is a component that we propose every year as a component of the severely adverse scenario, it would support understanding better the narrative for the global market shock that we propose every year. We are also posing a number of questions to the public for this particular aspect of the scenario design framework as well as others. So we're looking forward to comments on these proposed changes as well as other aspects of the global market shock.
Thank you.
Thank you. If there are no further questions, we'll now proceed to stating our positions on the proposal, and we'll begin again with Vice Chair Jefferson, please.
Thank you, Chair Powell. I want to thank the staff for their presentations, as well as for their considerable work to develop the stress testing proposal before us today. The stress testing framework has been an integral part of the Federal Reserve's oversight of large banking organizations for over a decade. Stress testing supports the safety and soundness of individual institutions and promotes financial stability by evaluating how banking organizations are likely to perform under hypothetical severe economic conditions. I am attentive to the concern that the current stress testing framework could produce unpredictable and volatile results, which could affect the ability of institutions to manage capital effectively. Today's proposal would increase the transparency of the stress testing framework by disclosing a significant amount of additional information on the models and scenarios used. The proposal also establishes a process for requesting public feedback on changes to the stress test going forward. I support issuance of the proposal for public comment and look forward to reviewing the comments received. The public's comments will inform my views on any final rulemaking, which I will evaluate on its merits. Thank you.
Thank you. Vice Chair for Supervision Bowman, please.
Thank you, Mr. Chair. I support the proposal, and I once again want to thank our staff and the heads of our other divisions who are here with us today for their willingness to come and answer questions about this proposal and the work that you have all done. I think I've seen a number of the staff behind you, Doriana, Hillel, and Patrick as well, and just your dedication to this process. You've been doing this for a number of years, and it's great to be able to see the evolution for the transparency and predictability of the tests. So thank you.
Thank you. Governor Waller, please.
Big shout out to the staff for all their work. I support these proposals. The proposed changes will improve accountability, build confidence in the fairness of the process, and foster feedback and ongoing improvements to our models and scenarios. Stress testing is an essential element of our regulatory framework for large firms that assesses whether such firms have sufficient capital to withstand severe economic conditions. The results inform large firm capital requirements by helping to size the stress capital buffer requirement. It is critical that we provide sufficient transparency into how these important risk-sensitive requirements are calculated. Last year, the board announced it would be improving the transparency of the stress test by disclosing and seeking comment on the models and scenarios used in the test. Today, thanks to the tireless efforts of Vice Chair for Supervision Bowman, this promise is being fulfilled. These proposals will maintain the risk sensitivity of our capital framework and the effectiveness of the stress test. Regulation of large banks affects their business and their ability to provide credit that supports the economy. As noted by staff, greater transparency would instill confidence in the fairness of the stress test and would create an important pathway for public feedback, which will allow the board to improve its models and scenarios. For these reasons, I support the proposals to enhance transparency of our stress test and release the 2026 scenarios for public comment. I look forward to reviewing comments. Thank you, Chair Powell.
Thank you. Governor Cook, please.
Thank you, Chair Powell. Since the Supervisory Capital Assessment Program in 2009 Stress tests have been a critical tool both for the supervision of the largest banks and for monitoring financial stability risks. Using thoughtful, rigorous stress tests also has provided a more risk-focused alternative to higher through-the-cycle risk-based capital requirements. I would like to highlight two fundamental benefits of our stress testing work. First, its value as a source of data on the largest banks and on overall financial stability. And two, the trust and confidence that a rigorous stress testing process creates in the resilience of the U.S. banking system. First, the data collected through the testing process have been important in their analytical value. The data allow us and participating banks to consider their particular risks in granular detail across a range of macroeconomic environments. We also use these data internally to assess banking system exposure to novel shocks for financial stability analysis. While we must be attentive to the burden of our reporting requirements, the benefits of maintaining granular stress testing reporting data are large and central to our supervisory and financial stability analysis. Second, the trust that a careful stress testing regime engenders is key to the strength and stability of the overall U.S. banking system. By disclosing banks' performance on the stress tests and detailed information about the rigorous scenarios, the board helps ensure that market participants and other members of the public can be confident that the U.S. banking system is resilient across a range of potential adverse scenarios. I am aware of the concerns raised about disclosing even more granular information about the board's models. Nonetheless, the changes to our stress testing regime proposed today could improve our model's ability to capture risk while maintaining both a rigorous stress testing process and the analytical value of stress testing data. First, with respect to data, although the proposal will reduce the overall information collection burden, it preserves the most important disaggregated data that can help us identify risks as they develop at specific banks and across the financial system. Second, I am optimistic that the changes proposed today preserve the board's capacity to administer a trustworthy, effective stress testing regime. The proposal contains certain policy design features aimed at maintaining the rigor of the stress test by reducing the potential for gaming or window dressing behavior, such as expanding the date range for the global market shock. Further, the board, as a supervisor, has other tools for addressing unusual or anomalous stress test results. Market confidence in the stress test comes from the fact that the scenarios are indeed stressful, and thus the results suggest participating banks can withstand a broad range of future adverse conditions. We must remain vigilant that our scenarios continue to be sufficiently rigorous to continue to warrant that market confidence. I hope to receive varied and thoughtful comments with ideas for improving the models and scenarios, including how to capture a wider range of risks and on potential mechanisms to minimize window dressing, gaming, or similar actions. In addition, I would be interested in hearing from the public on whether the board should also conduct exploratory scenarios and analysis, not necessarily tied to capital requirements, on a wider spectrum of potential threats to overall resilience. Finally, I believe it is critical that we meticulously study the cumulative effect of changes to our regulations. A series of reasonable, well-intentioned, incremental steps can nonetheless result in oversized reductions in capital and other prudential requirements that could materially reduce the resilience of our banking system. I especially look forward to reviewing comments from the public on this topic and to staff analysis on this issue for potential future proposals. Again, I want to thank staff for their work on this proposal and for organizing a public board meeting today. I also want to thank stakeholders for their engagement and for taking time to attend this meeting. I look forward to reviewing the comments we receive and working with my colleagues to find practical, efficient ways to preserve the important role of the stress testing regime.
Thank you. Governor Barr, please.
Thank you, Mr. Chair. I've submitted a full statement for the record. I just want to summarize briefly my comments here. I cannot support the package of changes to the supervisory stress test presented here today. Disclosure of the models and scenarios will make the stress test weaker and less credible. The proposed changes to the framework and models risk turning the stress test into an ossified exercise that will provide illusory comfort in the resilience of the system. They will lead to overly optimistic projections in the stress test, both because of less conservative modeling choices and because of the potential for gaming by banks. This will lead to weaker bank capital requirements, a result that is inconsistent with the board's previous statement that the proposed changes would not be designed to materially alter capital requirements. In addition, the more routinized nature of the stress test will lead banks to reduce the capital management buffers that they hold above required capital. It will also disincentivize them from paying adequate attention to independent risk management. Altogether, these changes will leave banks in a worse position to weather stress. What's more, the steps taken today will be difficult to reverse. For example, if public comments demonstrate that the costs of model disclosure outweigh the benefits, there is no way, unless and until the models change materially, to undisclose them. In conclusion, it's critical that the stress test remains a dynamic, rigorous process that allows supervisors, banks, and the public to understand vulnerabilities in the banking system and at individual banks. I believe today's proposal will significantly weaken the stress test and consequently bank resilience. I have deep concerns that the set of changes the board is now considering risks reliance on a stress test that can no longer effectively assess the resilience of the largest banks and lacks credibility, thus putting our financial system and the economy at risk. I find the board's choice today regrettable, and I cannot join it.
Thank you. Governor Myron, please.
Thank you. I first want to thank the staff who worked on the proposals and made the presentation today. Thank you for all of your work and time on this matter. I support the proposal because of its key feature, which is increased transparency. The Federal Reserve stress test has been obscure since inception and has not yet faced the rigorous testing the disclosure and public commitment will provide. Regulatory transparency has many virtues, including increasing trust in the regulator, providing an appropriate level of predictability for regulated entities, enhancing democratic accountability, and improving the quality of the underlying regulations. I think that over time, this process will improve the quality of the stress test and increase confidence in its results. I'm particularly curious to see how commenters respond to the design and calibration of the 2026 scenarios. While the scenarios presented are not Federal Reserve projections for the path of the economy, the set of assumptions underlying their design appears largely implausible and inconsistent with plausible macroeconomic outcomes and market distress. Using conceptually sound scenarios for assessing tail risks may be more valuable than relying on inherently inconsistent assumptions to achieve a desired level of stress. Thank you again to the staff. While I very much support increased transparency and predictability and thus lend unqualified support to moving forward with the proposals today, I'll withhold final judgment on the 2026 scenario until seeing comments from the public. Thank you.
Thank you. And from my standpoint, the U.S. banking system remains sound and resilient with strong levels of capital and liquidity. I am committed to preserving that strength. Stress testing enables the board to assess whether large banks have sufficient capital to absorb potential losses and continue lending under hypothetical severely adverse conditions. For more than 15 years, stress testing has been a key component of our regulatory framework and supervisory program. In view of the evolving legal landscape, last December, we committed to increasing the transparency of our stress testing framework and reducing the volatility of stress capital buffer requirements. Today, we're following through on that commitment. We propose to disclose and seek public comment on the models that determine the hypothetical losses in revenue of banks under stress and on the hypothetical scenarios used annually for the test, including this on the scenario for 2026. As the proposals are implemented, we'll continue to make sure that stress testing remains an effective test of the resiliency of large banks. For these reasons, I support seeking public comment on these proposals, and I look forward to reviewing the comments we receive. Thank you again to Fed staff for your presentations and the excellent work done to prepare these proposals. We will now proceed with a vote on the proposal. I need a motion to approve the publication for comment of model descriptions and the 2026 stress testing scenarios, a notice of proposed rulemaking on enhanced transparency and public accountability, a notice to invite comment on the 2026 stress testing scenarios, and the publication of these notices in the Federal Register, and staff to make technical or non-substantive changes to prepare the materials for publication.
So moved.
I need a second.
Second.
Second. After I call your name, please indicate your vote, yes or no, on the proposal. Vice Chair Jefferson,
Yes.
Vice Chair for Supervision Bowman,
Yes.
Governor Waller,
Yes.
Governor Cook,
Yes.
Governor Barr,
No.
Governor Myron,
Yes.
and I vote yes. The motion has carried and the proposal is approved. So I'd like to close by once again thanking staff for your hard work on the proposal. We look forward to receiving the comments on the proposal and encourage members of the public to share their views during the comment period. This meeting is now adjourned. Thank you.